Welcome, everyone. We've got April's Verivest webinar, and today's guest is Fortra Law, Kevin Kim, leading the charge. Matt, take it away.
Thanks, Kylie and Cy, for putting it together. As always, I appreciate it. Hello, everybody. My name is Matt Burk. I'm founder and CEO of Verivest Fund Services. And today we're here with Kevin Kim. We're going to talk a little bit about what's changed in the market, what's going on, things that are happening out there, and what Kevin's seeing. Um, Kevin's a super active fund formation lawyer and one of the most active in the country. I've known Kevin a long time. So, Kevin, welcome back to the show.
Thanks for having me, man. Yeah.
Yeah, appreciate you being here. Why don't, for those few people who maybe don't know who you are, which there probably aren't too many because you're pretty well known in this industry, but for those folks, why don't you start and give us a quick background on yourself and your practice and kind of who you are, what you do, and all that for context?
Sure. Yeah. Our firm is really entrenched in, I would say, private lending, real estate finance, both commercial and residential. My practice is corporate securities. I lead the firm's securities division, and I would say fund formation, any kind of securities work in both real estate and real estate credit is what we are very well known for. We do a lot of syndication, fund, REIT, all types of public private. We can do a lot of that, and the interesting part is we're doing it on both sides, right? So we're helping real estate sponsors build their strategies to raise money, but also we do a lot of debt fund formation and syndication work for the credit world. But also we can do it outside of those two industries as well, right? So we can handle the work both in hedge and PE and VC as well. But by virtue of our firm being so active in real estate, we do a lot of that.
Yeah, we first met, I think, back at the American Association of Private Lenders many years ago, and kind of run into you guys for years and years. So yeah, I know you guys have done a ton of this stuff. So I think you're pretty well qualified to speak intelligently about some of the stuff happening. And one of the things I
Mhm.
wanted to start with, Kevin, is I know that back in the middle or toward the end of March, there was
Mhm.
some news that came out of the SEC specifically around digital assets. And I know there's been a
Mhm.
lot of talk in the last, I don't know, going back probably at least 5 years, maybe longer, around
Yeah.
the development of, with the blockchain and tokenization and all of that. People were pretty fired up about it early on, but it's been pretty
Mhm.
slow to adopt, partly because of the regulatory environment being not particularly clear. But the SEC came out with some there, and they're not, I don't think they're not laws or regulations or anything, I don't believe, but it's statements of clarification around digital assets. So what do you think? Can maybe summarize your understanding of that, what you think that, how that
Yeah.
impacts the market going forward?
Well, I mean, the commission, this administration's SEC was, they saw the writing on the wall. And they said, listen, we have to figure this out. And so they jumped on it. The task force was stood up. The current chairman is much more well, he understands the asset class a little better. I think the enforcement agency, his leader, director, he understands it a little better. So now, the one thing that would meaningfully change was clarification that it's actually more of a commodity on the crypto side. I would call it the crypto side. Um, there was no guidance as it pertains to I would say tokenization by means of fund managers, but I think that clarification now puts us like the age old question in our industry has always been digitization. Does that lead us down into the path of cryptocurrency? Or are we now is it just tokenization or digitization of the asset class? And now we have much clearer pathways, right? And then in the mortgage sector, we also have this wide push toward digital mortgage, and so that's increasingly in high demand. And I give credit to the folks over at Figure; they're really doing a lot of work in that world. And what that all means for us as sponsors in real estate and real estate credit is both the assets themselves are being moved toward digitization. So digital mortgage is a big thing. It's coming our way, and I think we have to be ready for it. But on the capital raise side, I think the pathways have been relatively straightforward, and I don't think they're going to change now that we have clarification. So it's good. Um, digitization of a security, I think it's a pretty straightforward exercise. A private security is a little more complex because of the trading issues that come with it. But there are platforms that support it. And now that they have the clarity that they're not transacting in a weird way,
Yeah.
it seems to me that a lot of folks are really leaning into it. I wouldn't be surprised if we saw, a fully digitized securitization or fully digitized, real estate syndication come out, fully supported by blockchain. The issue on the real estate side is that, you really can't digitize the recordings, but you can digitize the mortgages pretty easily. So
Yeah.
that's
What
becoming
are
an
the
interesting thing.
practical implications of all of this? Like, because for a fund manager, I mean, I think ultimately, right, what is the investor buy? Like, we're talking about pooled funds, let's say. I mean, it
Hmm.
would still apply to a syndication, which is really just
Yeah, yeah.
an
It's
SPV.
it's just another way. If you simplify it and distill it down, it's just another way to, I guess, um, the best way to is to characterize the investment, right? So you're still buying units, right, or notes or whatever. You're still buying the thing you're planning on buying. It's just the characterization of that asset is that investment is now in a digital form, right? And so it's supported by a blockchain service provider or trading platform that allows for some liquidity, not a lot of liquidity, but some liquidity. So it does create unique pathways for sponsors who are raising money. It gives them, the ability to offer secondary liquidity even in private markets to some limited extent. It also allows them to lean into that investor base that may be more excited about a digital asset. What's interesting is that there's an evolution happening on that side of the world. It's kind of a support feature to these funds. And whether or not that's going to create marketplaces or trading platforms that are more robust is something that we're expecting, but we're looking out for that. Um, the interesting component is there seems to be movement kind of upstream in capital markets in utilizing these tools to provide interesting alternatives to liquidity and financing to the sector. And so, I mentioned Figure earlier. They were kind of the ones that started all this, but there's a lot of other shops that are working on this. And that's an interesting move as well, because it may take that form instead. And that
What is
allows.
that? Can you describe that? I mean, like, is that
Yeah,
you're
so one
talking
good
about
example
making
is there
loans
are
against the
conversations
private
around
assets?
yeah, I mean, the idea on the capital market side would be more like a bond marketplace, almost like a securitization to provide financing as opposed to like a traditional bank or an asset manager deploying capital with just a traditional equity or debt-based slug is they're using crypto and digital assets to create a means to fund via those digital assets, which are basically bonds, right? And then the marketplace will be driving the pricing through blockchain technology, right, based on demand and trading. So almost like a private slash semi-public bond trading market that'll allow financing to come downstream. That's one option that it's easily
Allow financing to come downstream to what? Like,
it
are
can
they
be a number of
financing?
things.
Because my understanding is like because right now, right, if somebody buys, if you're raising money in a 506 Reg D fund, which is
Hmm.
the main thing instrument, right, that these managers create, whether it's investing in mortgage loans or direct ownership of real estate, right,
Hmm.
either way, it's a 506 Reg D fund. Investors are typically buying shares of that fund or units
Hmm.
in that fund or ownership interests, right? They're LPs or they're members if it's an LLC, right? And they own the fund. But that
Hmm.
is subject to restrictions on their ability to redeem or to trade, right? It requires
100%.
the consent of the manager if they want
100%.
to sell that unit to somebody else, et cetera. And there's always what do you call it, lockup periods, or they can't just, it's not imminently tradable back to the manager, et cetera. So there's
Correct.
restrictions, which is one of
Correct.
the drawbacks from an investor perspective, of course, because this is an illiquid instrument. So the more that theoretically, right, tokenization and digitization eventually gets to the point where it allows those investors, those LPs, to either sell or trade, right, or borrow against, and thereby, right, provide some liquidity, even if it's limited, to those investors. Do you see, and that's in there's the term RWA, real world assets,
Hmm.
tokenization, real world assets. Do you think that's imminent? That's coming down the pike? If so, how soon? What are the
Yeah.
challenges to doing that? What are the advantages to doing that?
Well, the idea, the thesis is very attractive, but it's kind of reminiscent of crowdfunding in the context of it needs a lot of infrastructure and a lot of capital behind it to actually be done be executed well. So I don't know that it's going to be widely adopted by smaller sponsors because the cost of executing that kind of project is going to be very, very high. In
Yeah,
the private sector, if you wanted to do it, you'd have to engage with some of these digitization and digital securitizer platforms. That what they're doing is allowing for a limited trading platform through the broker dealer, and obviously it's going to take time and money to do. There is windows to do it. It's very limited, but it's doable. It's not freely tradable, but Reg D does allow for some limited liquidity, secondary trades in isolated circumstances. So with a broker and a transfer agent, it can be executed upon. And the idea behind the digital asset component is just to make it easier. However, engaging with a company like those, engaging with these kind of platforms that have the technology in place already, which is typically the way a Reg D sponsor will do it, can be quite costly.
yeah,
Now, that's why I think that it's more likely we'll see a wider adoption upstream because they can invest in the infrastructure relatively easily.
yeah,
And that'll take the form of more either asset management acquisition or maybe financing. And financing is a high likelihood and because it's easier to deploy. And the financing would be typically just an alternative means of either leverage to these debt funds, which is
yeah,
an opportunity in and of itself, or different, like basically on the real estate side, real estate financing will take the shape of digital mortgage. And I think that's coming. I don't think that it's being denied. Our industry colleagues in private lending are all talking about it. It's just there's certain obstacles when it comes to local regulation. Like for example, certain states will never allow for it because they just don't understand it.
yeah,
Reporting is difficult and those kind of minor issues. But over time, those obstacles will
yeah.
be overcome by these larger organizations because they have the working capital to do it.
Yeah, I think that's typically how you see it in just about anything, right? Is the very large organizations need to invest the capital initially to
Yeah.
create all the infrastructure to allow it to happen, and then it filters down eventually
Hmm.
to where it becomes more available at a more reasonable cost to more people. So realistically, it's probably still years away from
Hmm.
LPs practically having a lot of capacity or ability to trade or turn or
Right.
make liquid those private shares in these Reg D funds.
I mean, we've done a few of them over the years, but we discovered it really pairs well with sponsors are not only able to fund those costly endeavors, but also have the sophistication to partner with that kind of broker shop
Yeah,
and get it done. And it requires it's a pretty heavy lift. So it's not for everybody, but I think
yeah,
eventually it may take a shape that it's really easy to digest and really easy to process. And then that'll
yeah,
come. I mean, I'm bullish on it because the idea, if you look at the news, that a lot of the Wall Street types are making big investments into the digitization and tokenization, and even the exchanges are. And so I think that they're widely adopting the technology because for them it mitigates their fraud risk. So it's a huge investment for them on the upside because of that. So
yeah. I think it's inevitable that, if you fast forward, 10, 20, 30 years, I think that's just going to be commonplace. But right now, it's
mm.
still, there's a long way to go before
And
it
real estate is
becomes
also remarkably
practically
slow to
speaking.
adopt technology, very slow
Yeah,
to adopt it.
yeah.
Yeah.
Everything moves a lot slower than people think it's going to, and stuff like this. So, if that's not the case, then what are you seeing today? And it's like, what is the fund launch reality?
Yeah.
I mean, how is your business? Do you see more people trying to do it, fewer people trying to do it, about the same? What do you see happening out
Well,
there
the
in the
market right
fund?
now the real estate market's is facing its first real headwinds in a long time, I think, and capital markets is echoing the same sentiment, and LPs have had a the toughest go as they've ever had before. The real estate's had its ups and downs, and then I think we're starting to see that starting to come out. But there's so many LP stories out of the real estate sector, both syndicators and funds investments that got wiped out, and that's the harsh reality of commercial real estate. Uh, but that seems to me, at least at the middle market level, to be starting to make its way out, and there's deals being done now. Q1 was a very quiet time. 2025 was a very quiet time for real estate. But we're starting to have more conversations in that regard. But it's definitely slower than it once was, based off of like historical activity. On the credit side, there's been a significant increase in, I guess, enforcement action and challenges with these fund managers and these sponsors. And so LPs are much more sensitive to that. So new fund formation is definitely not as active as it once was. What's interesting, though, is that it's likely to take a turn because capital markets is also suffering, not suffering, but they're tightening their criteria. They're concerned about fraud. They're concerned about double pledge. So they're likely to make things a little more stringent, and that pushes down to the midstream market where they're going to have to start making a choice. Well, if capital markets can't fund my loans, I'm going to have to self fund myself, and so that leads down the fund conversation. So that's likely going to be the product of this current cycle. At the same time, LPs are very sensitive right now. There's a lot of bad stories in the industry, in the fund world, and that's really unfortunate to see. Um, but I think that the vast majority of sponsors are still very well-heeled people, and they want to do the right thing. So that's I don't I'm not bearish on the fact that the sponsor community is bad, but I am concerned about the LP capital being so sensitive. Um, but overall, I think it's interesting just because we're kind of in that transitionary phase right now, and it's hard to say what's going to happen. But all things being equal, I think the direct lending model is likely going to make a much bigger comeback in the next 6 to 12 months.
Yeah, I would say I'm seeing a lot of the same things. I echo a lot of that sentiment. I think that it's just been it's funny. I talk to a lot of people in the sponsors that have been around a long time, very capable, quality people who've had, a challenging time here these last few years. And I've
Hmm.
heard this more than once from, I mean, in fact, many times that in they talk to a lot of people and they say, yeah, the downturn in commercial real estate or the recession, and people are like, what are you talking about? Like, I mean, for many, many people, the devastation in the commercial real estate side is worse this time around than it was coming out of the Great Recession. I mean, it's been that bad for a lot of people. I feel like you're right that, and not only in real estate. I mean, I'm seeing it too in private equity and in some in private credits having its challenges these days too,
Yeah,
right? It
yeah.
kind of
They
exploded
have
for the
so many
last few
external
years.
impacting factors. I mean, the AI apocalypse is making a huge impact on private credit, and that has meaningful impact on a lot of our clients because a lot of that financing trickles downstream because there's impacts to that on working capital financing for a lot of these, I guess, vendors that play in the real
Yeah,
estate sector. And then there's also the impact just generally with LPs. LPs don't differentiate private credit with real
exactly.
estate credit, and so there's a lot of that going on too.
Yeah, well, paid a lot of private. I mean, look, when private credit was the thing to be in, a lot of real estate private lenders, were had a lot of pressure to rebrand or label themselves as private credit, which they really are. It's private credit. It just happens to be backed by real estate, right? But at
Hmm.
the end of the day, I think you're right. LPs that have come into the private sector, whether it's real estate, whether it's real estate credit, whether it's private credit, private equity, they have a hard time distinguishing one
Hmm.
from the other. And at the end of the day, pretty much all of those sectors have had their own challenges that have meant either delayed return of capital or capital and capital calls, having to put more capital in, or
Hmm.
complete loss, or partial or complete loss of capital. So I've seen that there's a lot of challenges for people to raise money. That said, I do see people doing it, and I know you're still working on fund formation. What do you think
Hmm.
is going on? How would you characterize the ones that are successful in today's difficult environment? Any common threads or things that you're seeing out there? Asset type,
Yeah.
structure, anything?
Um, well, on the credit side, a very strong majority in bridge lending, right? And so the conversations revolve around quality of loan, good markets, defaults, value proposition, fraud fighting, that kind of stuff.
Yep.
But it can all distill back down to the sponsors that are trying to do the right thing and do right by everybody, do right by their investors in particular, and do it the right way. It's less profitable, definitely less profitable, but it's definitely the story. The story is much more heartwarming for the LP and incentivizes them to get on board. Track record has become a very important thing, and it's unfortunate because like the some people just were fell victim to their local markets conditions. But that being said, track record also in getting out of those defaults and getting out of those bad loans or getting out of those troubled real estate deals and how they did it is really important. The story they had to tell. Um, you know, one of the things that we always tell sponsors is like it actually benefits you to be very transparent and truthful and just own up to the challenges that you're facing. No one's, especially in today's market, they're not likely to blame you. They're more likely to say, well, how are we going to get out of this mess together? If you're
Yeah.
like that, as opposed to if you're just trying to look out for yourself and cover things up, then you're likely to probably more face a lot of problems. And that's it kind of rings true with all the challenging cases
100%.
out there. And that's goes back to the sentiment of like, are you doing things the right way? When it comes to not like, and it's not even just like legal or tax. It's really more just a character thing. Like, are you approaching this with the mentality of best practice, transparency, and honesty? And that seems to me those kind of sponsors that are actively raising in today's market as experienced fund managers, they're raising money and they're raising good money and they're performing. So it's happening. It's definitely happening.
Yeah, it's sporadic. I mean, I definitely see that, depending on what stage of the market you get in, I do see a whole new crop of people coming into the market who've
Mhm.
maybe been involved working for some other group or a larger group and experiencing those things that are now at the stage of their life or career where they're going out and hanging out their own shingle,
Oh
starting
yeah,
their
there's a
own
lot of that
thing
going
there.
on.
Yeah, I mean that I think is that a good chunk of what you see happening in your fund formation business or
It's probably just maybe a quarter. It's always been about 10, 20% of like, spinning off, doing my own thing. The vast majority are existing sponsors. On the credit side, the vast majority are existing sponsors who make that critical decision that, hey, I think we have to be a direct lender. I think we have to be a balance sheet lender. Therefore, fund, leverage, line of credit
yeah.
kind of conversation. On the real estate side, it's really just more the vast majority are it's that we're doing the same exact damn deals. Syndication sucks. I hate doing it, and I need a better solution. And credit is asking for it as well. So there seems to be a lot of that going on. Is that credit is actually dictating the strategy a lot more than usual these days, which makes sense. There's a lot more capital in credit, and so that makes a lot more sense right now.
How has your business kind of changed and evolved? I mean, in the last 10, 15 years, as you've seen more and more people kind of come into this space and all the things that have happened, have you,
Yeah,
and
yeah.
AI and everything else, how has your business evolved?
I mean, the nice part is the industries on both sides of the house have grown up meaningfully in the middle market, and that allows higher sophistication, higher quality sponsor, more tools available to them to fight the good fight, and also prevent bad things from happening like fraud. Uh, the big evolution in credit and private lending the past 10 to 15 years has been the evolution of capital markets. What was just loan buying and table funding and correspondence is now transitioned into full-fledged securitization. So that's making a meaningful impact on the strategy, and you're seeing more and more lenders starting to realize, well, if we're going to achieve that objective as to do a securitization, we're going to have our own balance sheet to support it. And if they're not doing that, they're usually partnering with someone very, very robust on capital markets. And capital markets is the impact of them meaningfully playing in a big way in private lending has been the big shift. We've had to change our approach. We were purely a direct lender and I guess broker counsel, and now we work with them as well and counseling them and helping them get compliant and helping them with their strategies, and that's been a big shift for us. On the real estate side, past 10, 15 years, it was really hot for a while and then it just kind of fell off a cliff because
Yeah,
most of it was commercial real estate. And so, you know, we were doing a good amount of
yeah,
work in, industrial, and hospitality and multifamily, and that just kind of fell off a cliff. And that
yeah,
just by virtue of, I joke that it was our turn. One of four had its problems. Commercials having its problems, but they're making it out, and I think the good sponsors are now finding good opportunities. So we've had to
Yeah.
pivot, and it was interesting because as that started to give way, credit started to really boom. So we were able to pivot pretty easily.
Yeah. Yeah. I had a question I was going to ask you here that's skipped my mind here from, oh, you've mentioned fraud a couple of times in this conversation. And
Oh
I know
yeah, oh yeah,
fraud's a big deal out there. Particularly, I hear about it a lot in the mortgage space.
oh yeah,
So it's borrower fraud. It's people like
all
sort of
kinds.
systematically figuring out ways to try to rip off lenders. And, yeah, what do you see happening on the fraud side out there?
Yeah, I mean it's mostly operational, right? So for lenders, it's operational in the context of underwriting, right? So you have the big scandal out east with appraiser fraud and broker fraud. You have consistent issues with borrowers with, uh, I guess you can call it loan application underwriting fraud, mortgage fraud,
Yeah.
right? So like doctored financials, lies about occupancy, lies about stabilization, fraud in the construction draws, and the thing right now is the mission right now for a lot of lenders is to how do we combat this,
Yeah. It's hard.
and it goes back to I would say really old school traditional approaches where you would have found it if you took that approach, layering on top of that some of these interesting AI driven tools that are helping clients analyze these documents quicker. And so that's been
Yeah.
really, really valuable. And also helping them do a gut check on an appraisal, helping them do it's a reevaluation of the asset as it's flowing. Occupancy fraud and financial instrument fraud is a huge issue, and that's really easy to combat with the tools we have available to us today. But yeah, that's fraud is a major issue. As credit became more robust, borrowers, borrowers like to lie and cheat sometimes, and that's the number one thing right now that all lenders are concerned about. I think the nice part is that still private lending at the middle market level is very, very provincial in the context that we all know each other and where a lot of
Yeah.
us are friends, at least in the regional markets, and they can share intel.
Yeah.
And that's been very helpful. They've been sharing a lot of resources as well to try to combat this. The other issue that we're facing on the fraud side is more in the capital markets and the banks, and they're concerned. They're heavily concerned about double pledge. Right? We had that scandal come out of the UK. There's been multiple scandals here in the US of loans being pledged twice, and that's just not
Yeah.
okay. That's wire fraud, right? And unfortunately, being as fragmented as we are in credit, there's a lot of bad actors out there, and this time around, the commission and the FBI, they're not taking it lightly. They're being really, really strict about this kind of stuff. So they're really taking it upon themselves to be very protective when it comes to what they're considering retail investors. So that's really
Yeah.
good. I think
Un
that's a good thing.
Unfortunately, there's just always some portion of humanity that operates that way. I mean, you see it
Yeah.
constantly in
Yeah.
technology, phishing and email fraud. And like, I mean, I get constant, I mean, we're constantly combating it,
Yep.
even at our little shop, right? In terms of people, sending things on texts and new ways of doing it. And it's getting more and more sophisticated. It's part
Hmm.
of the human condition is having to deal with it,
Yeah.
unfortunately.
But I'm optimistic. I think the industry is much smarter and much more ethical than people give it credit for, and I think they're all finding lots of tools to help themselves, but also they're coming together and rallying around this. And so that's very heartwarming from my perspective, and I think that people are going to solve this problem because the business community is going to solve this problem, not the regulator.
Yeah, no, it's hard to regulate stuff into existence, but
Hmm.
people who are going to do bad things are going to do them whether the regulations exist or not. So we have a couple of questions in here I'll ask, and if anybody else has any questions as we get here at the bottom of the hour, please let us know. But one is around and ask an investor asking if he could invest his Bitcoin in a direct real estate ownership syndication. And I've seen this a few times where
Yeah.
some of these funds have had, they want to have digital assets come in. Have you seen any way to successfully do that?
Well, the ultimate challenge is we're real world asset, right? So if we're going to deploy capital into real world asset, how do you convert the Bitcoin into capital, cash, US dollars
Yeah,
to buy the real estate or deploy into construction draws or whatever you're going to have to do? And we've had it where it's similar to a like kind investment. The challenge with like kind is always valuation, right? So there's a lot of solutions on the table. One thing that you could easily do is coordinate with the wallet provider, liquidate, invest, and then
Yeah.
just turn it into cash, right? And obviously, you're
Yeah.
gonna have a taxable event, and that may not be up that investor's alley. Taking it directly would only work in the context of if you're able to lever it or borrow against, and that would be something that would be adding more risk. So the question of the sponsor's risk tolerance. All of this that I just mentioned, everything I mentioned requires additional disclosure. And so it's a very nuanced disclosure because the investors have to understand not only that you're liquidating the currency, but you're also going to be liquidating it and there's going to be a taxable event. It's payable to them. It's not payable to you. It's happening before they invest, all that kind of stuff. And then you have their consent to coordinate with the wallet, AML KYC to the wallet. There's a lot of that has to happen. And so disclosure is going to help you there. And but the challenge is like, is all that stuff, all that effort worth the exercise? And typically in a syndication, it's not. We've done this for funds where we coordinate with a wallet provider and allowing them to bring on, like, for example, USDC into these funds. And that's been an interesting exercise, but that would require meaningful disclosure.
Yeah, and I would say my general observation is that usually the added costs of doing all these fancy creative things end up becoming more burdensome than whatever value
Correct.
the manager thinks they're going to get out of it, at least at this stage.
Correct.
Another question is there a fraud guard service to check for multiple title orders on fall, like in the lending business? Do you know of any fraud
Yeah.
sort of?
I don't know actually. I don't run closing, so I'm not entirely sure whether there is or not. I would think I think I see who's asking the question. He can ask my partner Melissa. She probably knows. There's got to be. I would imagine your title company could probably track it too, but uh the
Yeah,
issue you run with that is like whether or not that amounts to fraud or not, if you pull title, it's kind of a question. So,
yeah, exactly. Yeah, I mean, I know that it's a big topic that comes up a lot, especially we've been pretty active in the California Mortgage Association the last couple of years, and to hear them talking about. So there's definitely resources out there that you can
yeah. And
find
I'll
to
give them
help with
credit
all.
in the California market is actually remarkable because it's so regulated. There's a lot of best practices installed that are almost now considered table stakes where you don't see it as often out here. Your big concern out here typically has more to do with like occupancy fraud issues or like it's a lying borrower on the purpose of a
Yeah,
loan. Whereas out east, it's rampant, and then it has more to do with valuation and financial fraud, and that's just a matter of you know I would just say the law of large numbers, and you start chasing that volume, you're bound to run into a bad actor.
yeah. I say we do quite a bit of fund admin for mortgage pool funds, and I'd say by and large, I haven't seen our. I mean, I've seen a few isolated incidences where you've seen it. Another type of fraud, of course, is when the actual manager themselves is committing fraud
Oh, no, I know it.
to the
Yeah.
investor. That's a whole nother deal. And you see those will blow up occasionally, right?
Hmm.
But I would say by and large, I mean, I've said this like in a lot of my posts. I mean, the vast majority of managers are good quality people that want to do the right thing and are
Hmm.
trying to do the right thing. When something does blow up in a big way, of course you hear about it, makes the news.
Yeah.
All the good managers running funds day to day don't make the headlines.
Yeah.
But that said, it's not a non-issue. It's something to
Yeah.
pay very close attention to.
Well, even with those sponsors, right, the ones that make the news, if you really distill down the facts, it's not like they enter the conversation saying, "I'm going to screw these guys over and ruin
No,
everybody." It's not that. It's more of like it's a product of a bad decision
that's
where they're
right.
like, they're trying to do something that where they don't want to like basically trying to prevent exposure to them,
Correct.
and they do something that's like it's questionable, but it's almost like they're trying to cover something up or hide the ball. And people forget we're dealing with securities here. Hiding something in the securities world or not disclosing something in the securities world is enough to be deemed to be fraud if it was intentional, right? So, and that's where the issues lie. It's like I'm not I'm not. It's kind of frustrating because the news will make them all sound like Ponzi schemes, and they're not really Ponzi schemes. They're really just it's fraud because the sponsor hid the ball, and that's where the lesson needs to be learned. And it's always the same stories. Like, guys, hiding the ball is just as bad, and really own up to the challenges you're facing. I guarantee you, your investors are less likely to call a lawyer or a regulator if you do that. And it just I don't know what it is about certain sponsors. They just don't like doing that, and that's really the frustrating part.
No, it's human behavior. People don't like to have to deliver bad news, right? It's
Right,
hard to
right,
do,
right.
and
They don't
like
want to eat their
depending,
vegetables. Yeah.
yeah, no, yeah. I mean, so yeah, mom always said eat your vegetables.
Yeah,
So, any other questions that we might have, please enter them in. If not, then we're going to wrap up. But Kevin, it's always a pleasure to chat with you. I know
absolutely.
you've been around this business a long time. If people want to reach you, how do they get a hold of you?
Yeah, I mean, you have my email right there. That's probably the best way. They can reach us on the website. They can find us on YouTube. The podcast is on every podcast platform. So, we're all over the place, LinkedIn. So it's pretty easy to find me. But yeah, it's just the email is the best way to reach me.
All right. Well, thanks everybody for being here. Appreciate you guys joining. Kevin, appreciate you showing up. Please join us again next month. We're going to have Richard Wilson, who is the founder of the Family Office Club, one of the largest family office organizers in the world. And Richard is going to be kind enough to join us next week. Should be a fascinating conversation about what's going on in the family office world and how to try to be active there and successful there and so forth. And he'll share some insight and some secrets on that whole side of the world. So please join us again then. And thank you everybody for being here. We'll see you again next month. Have a great day.